It's a huge sell-off in Venture Global this morning, and sometimes that's a good place to bargain hunt when something is oversold. So I used to own this. I sold most of my position. I still have a couple of shares and some options, but I sold out around here, 14 something. So I didn't top ticket here where it was almost 20, but I got 14 something, and I think my average price was around 10 or 11. So a pretty good return in a few months. But this, I believe, 90% owned by insiders, and the funds, about 90% owned by insiders and their backers. And they tried to sell off 10% of the shares. And I think they were looking at a price of $60, which the market didn't like, and then $40, which the market didn't like. And when it finally went public on 10% of the shares, it went at 25 and quickly dropped down to very reasonable levels where you could have bought here. So this company exports liquefied natural gas, and their biggest competitor is Cheniere. And Cheniere is a $50 billion company. And if you include the debt, it's $75 billion. And if Venture Global builds all the LNG export facilities that they are planning, they can be twice as big in capacity as Cheniere. So if Cheniere is worth 75 billion, this might be worth 150, possibly, but it's currently 61 billion as of yesterday. So why is it so cheap? They're mired in lawsuits, and they won one, and then the price went up, and then settled one, and this one they lost yesterday, so the market overreacts the way it does. And on some of these, I call them trading sardines. I'll just buy when they get to a low price and then quickly flip it when the market recovers. And I was doing that a lot with Crocs. I was buying it under 100 and selling it at like 104, 105, and I just kept doing that. Very small positions, but just pretty predictable. And this at this price, I feel like that's an overreaction because they did lose this lawsuit, but they won the other one and settled one. So the big overhang on this was the threat of the lawsuits from their customers. Some of that is in their favor. And even if it wasn't in their favor, I think the maximum loss, if they lost all their lawsuits, was under 3 billion. So if I recall correctly, and I feel like that would have been okay if you're buying at $10, considering the future upside. So let's talk about what they do and why this is in some ways better than Cheniere. So there's a huge difference in price with LNG between the US and Europe. And why is that? Because they use a lot of LNG in Europe, liquefied natural gas. There are sanctions against Russia, and they need gas, and gas is high, but we have nowhere to get it there. So Cheniere, which exports liquefied natural gas, and this company can make a lot of money because we don't use a lot of natural gas here, not as much as we do in Europe. So because we make a lot of it here when we're fracking and taking out oil, and we don't use as much of it as they do in Europe, if you got a lot here and there's a lot of supply here and not a lot of demand, then the price goes down. And in Europe, there's not a lot of supply. There is a lot of demand, so it goes up. So if you can get it from here to there, you can make some money on that spread. And this is trying to do it better than Cheniere. So Cheniere had the first LNG export facility. It took a long time to build, cost a lot of money, but it eventually worked out. And these guys have a plan where instead of one giant facility that takes years to build, they do this kind of in a modular way where a lot of the components are built off-site and just brought in, and it's a cheaper way to build an LNG facility. And because it is sort of modular, you can just keep building more and more of these as you go. And on two of their projects, they have already announced plans and gotten approval to expand. So if you see this many, as I said, you can just build a few more of these and just keep going and going instead of one giant facility and then build another giant facility somewhere else. So it's like a developer who builds single family homes instead of one giant apartment building. The one giant apartment building might be more profitable, but it takes a long time to build, costs a lot more money, and you can just hammer out these single family homes quickly. And it's very profitable. And the basis of the lawsuit is part of the way that this is set up. So these have, when they're fully operational, something called a nameplate capacity. And these are able to run about 10% more than the nameplate capacity for small periods of time. And so if natural gas prices go up a lot and they're running at 100% capacity, they can go at 110, not permanently, but it's sort of like putting your car in the red for a little while. And so they have about 10% more than their nameplate capacity. And if prices go up, they can overproduce and make money on that. So they've locked in the financing for long term at fixed rates, and they have long term deals with European companies like BP, and they get a percentage that's locked in, so everything is good. It's almost like a bond payment, and then you have that little extra 10%, which in the business is known as volumetric optionality, and that allows you to goose profits. And where they got in trouble is that nameplate capacity provision kicks in when the facilities are fully up and running, but natural gas prices spiked earlier in the year and the facilities were not fully up and running. And instead of selling it to their customers like BP and Total at the agreed upon prices, they were selling it to other people at very high prices. And that was the cause of these lawsuits, which went to arbitration. So it's not something that's going to drag out for years. And again, last time I checked, Venture Global won one, settled one, and just lost one yesterday. So the allegation is that they should have sold this to their customers, not on the open market. But a contract says what it says, and the market was sort of beating them up because, one, there was a risk that they would lose. But again, if you back out $3 billion or whatever the total damages might have been, it still looked like a good deal, which is why I bought in around today's prices and sold around 14. But there was also a concern that, well, if these guys screw their customers, new customers aren't going to want to sign with them. But that doesn't appear to be the case because they've signed new deals since then. And they also have gotten approval to expand their facilities at Calcasieu and Plaquemines. I'm probably mispronouncing that. But anyway, so that is what is going on with Venture Global. So they won one lawsuit, they settled another one, and today they lost one against British Petroleum. They still haven't figured out damages yet, but that is why the stock has gotten beaten up this morning. And normally on the first day, all the weak hands get shaken out here. So I would check back on this by the end of the day and decide what to do. Maybe it's worth it to buy in, maybe it's not. I'm just working through my process, not recommending buy or sell. But something you can do when something has a huge one-day move like this, and this doesn't apply to Venture Global, it can apply to other companies like Crocs or even Google. You know, sometimes they have a huge one-day move where they're down 10%. And sometimes you can trade options on it, which is very interesting. So if it was 12.5 yesterday, then buying a call would have cost you $480. So by 2028, it would have to be $17.30 to break even. But that was yesterday's prices. So now it's around $10. And let's assume that this is what will be the price today. No guarantee of that. But maybe there's some calls available where you would only need 1480 to break even instead of 1730. And that's if you like it. If you understand the company and you like their odds, that's one idea. Not that I recommend, I'm just telling you it exists. And another thing that's possible to do is to sell puts. So if you think it is oversold and it won't drop below 10, then as of yesterday, when it was 12 and a half, you could have sold a put for 390. And if it trades below 12 and a half by 2028, they could make you buy the shares, but you're getting almost $4 in premium. So even if they made you buy it at 10, your break even is about 860. And since the price dropped a lot today, it's very possible that you might be able to get that kind of premium on a $10 put, which would bring your break even to about $6, $6.10. So I don't know what the price will be on those puts. The market hasn't opened yet, but this is just an idea of how I like to play this sometimes. And again, not a recommendation to buy or sell. Do your own work. I'm just looking at a huge price move and thinking that with the cash I have available, what is the best option? Is it buying more of the common? Because I sold, I would say, like 90% of my position and just kept a few shares to keep an eye on it. And then sitting on the common for a few years, or because the options go out to 2028, is it a good idea to buy and sell calls and puts? Because one thing that a lot of people do is you can sell puts and use that money to buy calls. And so you're sort of not coming out of pocket with anything. And if it does really well, you got a position in this which is profitable and you didn't have to lay out any money. However, if it goes badly, you calls ended up worthless and you had to buy the shares anyway. So there's no such thing as a free lunch, and everything involves risk and reward. But I'm just working through my process here. Anyway, if you guys have thoughts on this, leave them below. If you have other things you'd like to see, drop a comment. If you want to support the channel, check the link. There's a Robinhood affiliate link if you want to sign up for Robinhood. And there's a Buy Me a Coffee link if you want to support the channel. Don't feel like you have to, though. Anyway, have a great day, everyone. And again, like and subscribe so that you'll see future updates on things like this.